Ladies and gentlemen, welcome back to the channel. I have a warning for all of you, and especially for the bears. The markets are so negative, you are most likely going to see a pretty nice rally here over the next couple of weeks, okay? Let me throw this first kind of thing that I'm noticing out to you guys, okay? The percent of stocks trading above their 50-day moving average is at 31.91%. So effectively, 68% or so of stocks are currently trading below their 50-day moving average. Okay, most of the markets are in an active downtrend. This might shock you. The last time we were this bearish, and we're actually more bearish today, was August 5th. Do you remember August 5th? NASDAQ was down over 6% in pre-market. It was the yen carry trade blow up, right? I hope we all remember this. It was just a couple of months ago. August 5th, the S&P was down at about 507. From the July 16th high until the low on August 5th, the S&P fell in total almost 10%. From that August 5th low until today, the S&P is up 17%. That was a great time to be buying. Now, the last time before then we were this bearish was April of 2024. And what happened during April of 2024? Well, the S&P fell about 6%. And from that low in April until today, the S&P is still up about 21.5%. Okay. So both of the last instances, markets were this bearish. It was a great time to be buying stocks. You have to ask yourself, though, what has changed? Did the bull market fundamentally change? Now, we had a hawkish Jerome Powell. We've had Fed officials like Austin Goolsbee since then come back and kind of walk back what Jerome Powell said that the markets did not like. Okay. I don't think Powell meant to be as hawkish as he came across. Now, either way, the dot plot didn't change that much. It kind of was in line with expectations. But yet, markets fell. Markets freaked out. And they were really freaking out even before the Fed. Okay, look at the RSP. The RSP died before the Fed. It died after the Fed. This is the equal weight S&P. It's still down 6.3%. So there's something very fascinating happening right now. And I'm just going to be honest with you. There's a lot of tax loss harvesting going on. Okay, the RSP fell at the lowest point following the Fed meeting on December 20th, down about 8% from the high. That's a correction in the broader markets. So you have seen a correction within the markets. Okay, that's a fact. But you have not seen a correction in the market cap weighted S&P. That's because big tech is held up. Now, why is that? Again, here's the secret. Tax loss harvesting, okay? The RSP hit its all-time high on November 29th. The next trading day later was December 2nd. When you tax loss harvest a stock, you have to wait 30 days to rebuy it. That's why you get the January effect, because you tend to see selling of stocks for tax loss harvesting purposes in the beginning of December, end of November, and then funds can start buying them back to start the new year, right? That's why you get the January effect where stocks tend to go higher. Now, you have not seen tax loss harvesting in big tech because big tech is outperformed. Not a lot of funds have losses in big tech, okay? But in other names in the S&P, they do. So you're seeing tax loss harvesting that has really caused this correction. There's really nothing else that has fundamentally changed, okay? We actually seen progress on inflation within the last inflation report. It came in a little bit hotter than expected on the headline number. Used auto prices was the main culprit, but shelter inflation started to come down. Services, excluding shelter, started to come down a little bit. We're making a little bit of progress. The only thing that really changed was the Fed was a little bit more hawkish than we were expecting. But nothing really changed. He was just a little hawkish. Okay, the dot plot was pretty much what we were expecting. So nothing from that point actually changed. 10-year treasury yields did go up, and they're sitting at about 4.5% now, which is higher than they were before. That's the only thing that really structurally changed, but that's just expecting better economic growth. So it's like, would you rather take slightly hotter inflation and a stronger economy, or lower inflation and a weaker economy? I mean, they kind of net equal each other out. Now, for anyone that does not know, between December 15th and December 31st, the S&P since 1950 has returned on average a 1.5% positive gain. And in fact, the days following Christmas, the next 7 days, which runs into the second day of January of the new year of 2025 in this case, tends to be positive 78.4% of the time. So now that we've gotten our catalyst out of the way for this market, you're most likely going to see a year-end rally. Now, today we had durable goods orders month over month that came in at negative 1.1%. And that looks a lot worse than the estimate of negative 0.4%. But last month was revised up from positive 0.2% to positive 0.8%. So including that, you kind of met expectations for durable goods orders today. Okay, CB consumer confidence came in lower than expected at 104.7. The expectation was 113, so that was definitely lower than expected. And new home sales came in a little bit better than expected, 0.664 million versus consensus of 0.65 million. Now, as you can see here on the S&P 500 today, 84.5% of stocks actually fell, were in the red today. 15.5% of stocks were actually green today. That is very much pretty capitulatory levels, okay? As long as things don't get worse from here, as long as there's not another crazy negative headline or, spooky thing that happens, I see this as a great buying opportunity for markets. But again, part of the reason why markets were a little bit fearful today is Apollo Global Management says that there's a 40% chance the Federal Reserve will pivot back to raising rates next year. And honestly, I just think this is purely bullshit. I mean, I think under a Trump presidency 2.0, we're going to see lower inflation than expected, right? Just inflation expectations are lower now versus before the election. And I think that ultimately will feed into lower inflation. And again, on the last CPI report, we actually seen progress in getting inflation lower in the sticky areas of the inflation report. So I think this is an upside surprise for next year. And I think that's a part of the bull thesis for next year. My bull thesis for next year is inflation falls more than expected, economy maybe not as strong as expected, but still strong. Earnings kind of coming in line with expectations. In that scenario, the Fed can cut rates a little bit more than expected, maybe 4 or 5 times next year. And boom, you have another, 20% gain for small caps or so next year. That is my expectation. Now, I actually think something interesting could happen to start 2025 with this tax loss harvesting in the broader markets and the resilience in big tech. You may actually see big tech get sold in the beginning of 2025 and a broader market rally kind of start to play out because, again, risk reward. Markets are in a correction right now internally, the equal weight S&P versus big tech at all-time highs or close to all-time highs. I like the taking my chances in the broader market versus big tech. And I think with these stocks being bought back via the tax loss harvesting that has happened in early January will likely fuel that broader-based market rally. And again, I will point out we really don't have any catalyst between now and really the first week in January. There's just not a lot going on. Today is a full day of trading. Tomorrow is a half day of trading. Markets will close at 1 p.m. Eastern Standard Time. Wednesday, markets are closed. Thursday markets are open again, full day of trading. All we have is initial jobless claims. As long as that does not come in really high, we're fine. Like bull market could probably start to catch some steam if initial jobless claims come in lower than expected on Thursday. And then on Friday, we have a full day of trading as well. And all we have is the goods trade balance, advanced data for November, and S&P Case-Shiller home price month over month and year over year. Like, we really don't have any data. Okay. And then next week, you have Chicago PMIs on Monday. You don't really have anything on Tuesday. You don't have anything on Wednesday. You have initial jobless claims on Thursday, but that's it. Okay. So you really don't have anything as far as economic data that will challenge the bull thesis at this point for the next 10 days or so. And again, I want to revert back to when markets are this bearish historically, you want to be buying stocks, right? Like 2022, you were sitting 15 to 20% of stocks trading above their 50-day moving average. Every time you got this low, markets bounced afterwards. Okay, in 2022, in 2023, every time you were at these levels, you should have been buying. And we're back at those levels. You want to be buying. Now, I'm not a financial advisor. I'm not a financial planner. But, I mean, it's pretty obvious. Okay. Even today, 1.32% of stocks are falling below their 50-day moving average. So, I mean, again, markets are even weakening today. It's a good sign you want to be buying. Now, CNN's Fear and Greed Index, again, is at 29. Yesterday, it was at 28. You're pretty close to extreme fear. Anytime the CNN Fear and Greed Index is in fear or extreme fear, you want to be buying that. That's a buying opportunity. And for the first time in a long time, market momentum is coming in fear territory. Stock price strength, extreme fear. Stock price breadth, extreme fear. Hitting the lowest breadth level you have been at in well over a year. I mean, like a very, very long time. It's plummeted recently. Put and call options, finally in fear. Market volatility is neutral. Safe haven demand is neutral. And junk bond demand is in fear. Like, when there is this much fear out there, you gotta just close your eyes and buy something. Okay, I'm not a financial advisor. I'm not a financial planner. Obviously, if this turns into a bear market, if the Fed needs to raise rates or something dramatically, different from expectations happens, like, we could go into another 2022 market again. What are the odds of that, though? Do you put those odds high? I don't. Okay, I don't think this is a 2022 over again kind of scenario. And I know some of you guys do, but you don't make money being bearish in stocks long term. And people are pretty damn bearish in markets right now. So personally, I'm closing my eyes and I'm buying. Now, does a rally happen this week? Does it happen next week? Statistically, there's an 80% chance of that. Does it have to happen? No. Could it not happen? Obviously, right? Anything's possible. But you have a greater chance of rallying over the next 2 weeks than not. Just to, get back to a neutral place on markets on the CNN Fear and Greed Index would be a 20-point rise from here. That would be considerable upside. So I like the risk reward. I like markets here because we're so negative. And that's the warning that I have. You need to be buying something. Not a financial advisor, not a financial planner. Your financial situation is different from mine. It's different from the next guy. Your goals are different than mine. My goal is to make as much money as possible. Your goal may be preservation. Your goal may be not to lose money. Okay? Our goals are different, most likely. Okay? Good balance of risk and value and safety typically is the best. But I cannot give you personalized financial advice. Just a good rule of thumb is when markets get this bearish within a bull market, you want to close your eyes and buy something. Even if you literally close your eyes and just scroll on the S&P and click something at random and buy it. Like, you just want to buy something when markets are this bearish. I like Applied Digital here. I like Dollar General here. Both of those serve different purposes. If you want a lot of risk with a lot of potential return, you could do like a Novartis semiconductor. I think that's how you say that. Very high risk, high reward kind of stock. It's up like 20% today. It's got some bright prospects going ahead. I think very speculative. I like the idea of buying anything here besides big tech. I don't want to be buying big tech. I think they're going to have a rough 2025, my personal opinion. But hey, we'll see. Healthcare also could be a big upside surprise in 2025, as that is almost the most underweight sector heading into the year besides industrials. Industrials are a little bit more bearish than healthcare, but healthcare right behind them. So nonetheless, let me know what you guys think about this information down below in the comment section. Have a great rest of your day, and I will see you in the next one.